This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
So this week's guest, we are super excited about having on Dr. William Bernstein. Frankly, I can't believe we had him on. I mean, when I started in the business, I was in, as people know, active mutual funds for the first few years. Then once we started migrating and realized the beauty and the reasoning behind evidence-based investing, you start looking out to different authors, and his books, The Intelligent Asset Allocator and The Four Pillars of Investing, were like two seminal books that kind of changed the way that I viewed the world. And I've been reading his stuff for 20 years now. So we reached out to Dr. Bernstein, and he graciously agreed to come on, which was incredible.
It was incredible. And I like you, have read his books. And actually, we mentioned on a recent episode, the most recent one that I read, Rational Expectations, which is fantastic. But yeah, like you, couldn't believe to be chatting to him.
Yeah, so he was a clinical neurologist. And then in 1994, when he realized he had to, because there's no pension plan for him, he decided to look into how the best way to invest was. So he took his approach, his medical evidence-based approach to managing his own funds, and that led him to a second career. And as he told us, he kind of gets bored easily. So he made a whole career out of becoming a writer. He didn't know he was a good writer, so he became an author, then co-founded his firm called The Efficient Frontier. And I was joking with him before we started recording that his website, his blog page, has not changed since I first started going on it, like 24 years ago now. It is literally the same setup. New articles, of course, but all the fonts are the same. It's kind of stuck in time, and he had a good laugh about that.
Yeah, there's no need for him to change it.
Not at all.
It still works.
So he's still a financial advisor. He co-founded his firm in 1998 called the Efficient Frontier Advisors. He still writes, but he's kind of moved on to different themes of writing beyond financial and investing, which he talks about in the interview. One
concept that I want to mention before we get into the conversation with Dr. Bernstein is value averaging, which is a bit of an obscure topic, but he'd written the foreword to a book about it, and so I wanted to ask him about it because I've gotten the question on more than one occasion from YouTube viewers and podcast listeners.
Especially with you having just written the paper on dollar cost averaging versus lump sum investing. This is another model.
Yeah. Value averaging, it's kind of like dollar cost averaging in the sense that it's a sort of systematic way to enter the market as opposed to investing a lump sum. But it's basically this, it's a strategy where you choose an expected return for the investment and you model how much that investment would be worth given some systematic contribution. So say it's $1,000 a month for 12 months. To deploy your $12,000 lump sum cash that you have. So with the expected rate of return, you can benchmark how much you should have at each interval, so at each month. And where value averaging differs from dollar cost averaging is that with value averaging, if the value is below the benchmark amount based on the expected return, then you would add more. You would contribute more to bring yourself up to where it should have been. And likewise on the other side, if it's higher or if it's already reached the level, then you wouldn't do your contribution that month. And so the idea is that you're buying more, obviously, when stuff is cheaper and buying less when stuff is more expensive.
So it's basically an autopilot around what dollar cost averaging would be plus the expected return. In simple terms, if you're getting way ahead, you're pulling back. If you're getting behind because of the markets, you're adding more money in to bring you back up to where you thought you should be.
To me, it sounds a lot like market timing. And I think Dr. Bernstein alludes to this when he's talking about it. It's like, on average, the best thing is lump sum investing. Dollar cost averaging, you're in most cases going to deploy the cash more quickly. But with value averaging, he said you might get really lucky. But you could get lucky at the lump sum too. So I don't know.
Yeah, I just love his approach. He's so deadpan in some of his answers. And a great way of looking at different issues. Also worth noting too, we recorded this on video. So if you like to watch the video, pop over to the YouTube channel. It'll be up there as well. As with many other of our interviews, we're getting more and more people watching it on YouTube.
All right.
Anything else?
The interview.
Let's go. It's our interview with Dr. William Bernstein. He joined us from his home in Portland, Oregon, and super thrilled to let you guys hear this. So please enjoy. Dr. William Bernstein, welcome to the Rational Reminder podcast.
Pleasure to be here, sir.
I must say, this for me is a particular thrill. And I must say, your books had a huge influence in my career as I transitioned from active world to the more evidence-based world back in the late 90s. So I really appreciate your work and the impact it did have.
Well, thank you.
So off the top, how important do you think it is for investors to understand the theory of investing?
Well, it's extremely important. If you don't understand that risk and return are joined at the hip, you're going to have problems from the get-go. Stocks usually, not always, but usually have higher returns than bonds do. And the reason for that is because they have higher risk. And if you expect the high returns, long-term returns of stocks, you are going to have to be prepared to take it into shorts every now and then, and sometimes in a very big way. Conversely, if you expect safety, then you're going to have to expect very low returns. And if someone tells you that they can give you high returns with low risk, that is the point where you make a 180-degree bat turn and run like hell.
Pretty easy framework for decision making. Risk and return are related.
Exactly.
I think this next idea ties right into that. And the question is, given someone understands the theory, how important do you think it is to have an understanding of market history to be a good investor?
Well, again, it's one of the essential pillars of being able to invest. And understanding market history means understanding several things. First and foremost, it means that in the very long run, both stocks and bonds can have periods of very poor returns. About once a generation and sometimes twice a generation, stocks lose about 50% of their value. In the past 20 years, stocks lost about 45% of their value in the early 2000s, more than 50% of their value during the financial crisis of 12, 13 years ago. And very recently, they lost about a third of their value very quickly before recovering. So that's the first thing you have to understand. The second thing you have to understand is that there's an inverse correlation between how good the economy looks and what future returns are going to look like. If you are compensated for taking risk, then you have to be compensated the most when the risks look the most frightening. So the best fishing is done in the most troubled waters, the most stormy waters. The very best time in U.S. history to buy stocks was in the early 1930s, when they were practically being given away. And if you mentioned buying stocks to someone, they'd either laugh at you or try to slug you. And the same thing was true in the early 80s as well. And, very most recently, in March of 2009, most people got visibly sick when they thought about the stocks in their portfolio. Those are the very best times to buy stocks, and that's one of the things that history teaches you.
That's one of my favorite lines, and I'm going to misquote you, but from Rational Expectations, which is the book of yours that I've read most recently, you said something along the lines of young investors should be praying for long extended bear markets.
Yeah, of course. And that gets to a theoretical issue called return sequence, which is that if you are in the accumulation phase of your investing career, you're saving periodically, then you should get down on your knees and pray, as I wrote, for awful returns, awful bear markets, great volatility, so you can accumulate shares at low prices. On the other hand, if you're a geezer like me, you don't want to see bad returns right off the bat. You want to see good returns right off the bat. So you can build up your nest egg a little more, so when the bad times come, you've got plenty of cushion. So how risky stocks are depends on where in your investing life cycle you are.
Yeah, I guess it depends on the correlation of your human capital to the stock market too. right?
Exactly, and that's an important term to think about. Is this business of human capital? If you have more human capital than investment capital, you want bad returns, and the opposite is true. If you work for the government or for the post office, then you can invest in the riskiest kinds of value stocks. On the other hand, if you're tied to the financial services industry, you want to be much more conservative in the way you invest.
But the real challenge is that these bad returns often happen in really bad times, like what happened in March of this year. So a lot of people equate risk as the volatility of these prices during these bad times. But would you say that these are the true real risks that long-term investors face?
Yeah, there are a couple of different ways to measure risk. Probably not a bad way, but not the optimal way is just to look at volatility. I mean, if an asset class is volatile, you know that it's risky. But the real risk is not just having the risk of bad returns, but having bad returns at a time when your consumption is going to take a hit. So you might lose your job. I mean, the worst thing that can possibly happen to you is to have your stock portfolio down and lose your job at the same time. And that's why stocks have such a high, one of the reasons why stocks have a high return is they tend to do the worst at the times when you're most likely to be doing the worst in terms of your vocational situation. Now, in the very long term, the most important measure of risk is to see a long-term decline in stock prices that can last a generation. We've never really seen that in the United States, all right? And I don't think you've seen that in Canada either. But you don't have to go very far back in history to see a nation that encountered that, and that was Japan. If you had bought Japanese stocks in 1990, now 30 years later, you are still well underwater. And if you were retired, you ran out of assets pretty darn quickly. And then if you go further back in history, back to the history of say, Europe, a lot of countries in Europe or Japan saw their securities markets absolutely destroyed. And they never really came back.
Yeah, it's an interesting contrast because that the short-term volatility is how people generally think about risk. But I think the things that you're talking about, the possibility of a generational underperformance of a market is maybe a bigger long-term risk. And it also changes the relationship where bonds, from that perspective, are arguably riskier than stocks.
Exactly. For example, if you look at the returns of U.S. long-term bonds, and I'm sure Canadian bonds behave the same way, between, let's say, 1940 and 1980, what happened to bonds during that 40-year stretch was much worse than it has ever happened to stocks, both in Canada and the United States during that period.
Do you think, in general, so we're talking about risk, and volatility is one way to measure risk, and it's probably how most people think about risk. Do you think investors are good generally at evaluating their own personal tolerance for volatility?
No, they're awful at doing it. And you're probably going to be asking me some questions about psychology. But the biggest psychological flaw, mistake that people make, is being overconfident. Men are particularly bad at this. Testosterone does wonderful things for muscle mass, but it doesn't do much for judgment. And one of the mistakes that a lot of investors, and particularly men, make is thinking that they're able to tolerate stock market risk. They look at how maybe if they're lucky, they're aware of stock market history, and they can see that, yeah, stocks can have these terrible losses, and they'll say, yeah, I'll see it through and I'll stay the course. But when the excrement really hits the ventilating system, they lose their discipline. And the analogy that I like to use is a piloting analogy, which is the difference between training for an airplane crash in a simulator and doing it for real. You're going to generally perform much better in a sim than you will when you actually are faced with a real control emergency in an airplane.
So how should people assess their risk tolerance?
The only way to do it is in real time and with the aid of a good memory. The one thing that I would urge anyone to do who's just starting out with investing, who's never invested in equities before, is to take it slow at first. Theoretically, what a young person should be doing is investing all of their money in stocks. But in fact, if a young person in the real world does that, their first bear market may hit them very hard. They may never invest in stocks again. So start at a 50-50 allocation, something like that, or something close to that, and then assess in real time how you behaved when things really go sour. And if you were able to just hold on and get through, that's probably the right allocation for you. If you're chomping at the bit during those periods and saying, "Gosh, I'm going to buy more," then you know that you can probably have a higher allocation. But if your thought was, "Oh my God, look at all this money I lost, I'm never going to do that again," then maybe you should be 30-70.
But how do you get people's perception to shift? Because a lot of people, for example, through the crisis this year in March, some people were biased towards this is a great opportunity. Stock prices have gone down, expected returns have gone up. Whereas other people, it's, oh, things could get a whole lot worse. I've got to get out and I'll sit in the sidelines and I don't mind missing some of the upside. Is it possible, do you think, to change people's perception around times like this? At this time, it is different?
No. Our emotional responses to our environment are hardwired into us by, probably millions of years of human evolution. And, you can't get rid of, the basic psychological underpinnings of investing, which is fear and greed. There's just no way you can get rid of fear. It's ingrained into us. I mean, 10,000 years from now, people, if they hear the hiss of a snake, are still going to be, are still going to be revolted and frightened and want to run away. The same thing will also happen to people 10,000 years from now when their financial situation worsens and the economy worsens. If we're still around in 10,000 years.
Your commentary on young investors starting slow is fascinating, and it's fascinating because it is at odds with the theory that I know you're familiar with, which is that young investors should use as much leverage as they can possibly get their hands on. So that leads me to want to ask you, should young investors be considering using leverage?
Well, the theory also says that in order to lose weight, you have to eat less and exercise more. And that's about the same way that I feel about leveraged portfolios for young people. I don't think there are too many people in this quadrant of the galaxy who are able to tolerate a leveraged stock portfolio. It looks good on paper. If you have a PhD in economics from Yale, it looks good. But for real people in the real world, it doesn't work so well.
Okay, so let's jump into a portfolio question. Do you still think that it's reasonable to expect return premiums from small cap and value stocks?
Isn't that a good question? I was just about to ask you the same thing. I don't know the answer to that, and I don't feel bad about that because I don't think anyone else does either. If you believe that there is both a behavioral and a theoretical component to the small and value premiums, that is, small and value stocks are riskier, therefore they should have higher long-term returns, then I think that at least some of the premium is still there. If, on the other hand, it's all behavioral, then with luck, people have learned about that and have arbitraged that away. Or I wouldn't say with luck. If that happens, it'll get arbitraged away. I don't think it's going to be as large to the extent that I believe that some of it is still due to risk. I think that it's still there, and I think we've seen the evidence for that just during the past 5 or 10 years. If you're a value investor, you've been very discouraged by the past 5 or 10 years, and a lot of people have given up on it. And a lot of people have said, value is dead. Whenever I hear from anybody that a certain approach is dead or a certain asset allocation, a certain asset class is dead, I perk up my ears because that means that all of the weak hands have sold out of it. And I think that's what's happening with value now. I do think the answer to your question is at least some of the value and small premium are still there. And the main reason why I believe it is because the valuations now of small and value stocks relative to the market are much more attractive than they were 10 years ago.
Mm-hmm.
Yeah, the valuations are unreal. I mean, getting to historic levels in terms of the spread in valuation between value and growth, particularly small cap value. Now, on that topic, and it kind of ties into the leverage question, I think your answer might be similar, but let's see. One of the questions we get a lot, because we talk about the data around small cap and value and the theory around small cap and value, and this leads people to think, well, why don't I just build a portfolio of 100% small cap value stocks? How would you answer that question?
Well, the reason why you shouldn't do that is for periods of 10 and 20 years and perhaps more, that can fail. You don't want to take that kind of risk just for a little boost of return. If anyone should heavily weight towards small in value, it should be a young person in the accumulation phase. All right, for the same reason that I talked about 10 minutes or 15 minutes or so ago, which is that if they do happen to have a long period of very low returns, then it's good to be accumulating them. So if you're a 20 or a 30 or a 35 or even a 40-year-old saver, it might make sense to heavily tilt towards small in value. I don't think that people much over the age of 35 or 40 should do that very, very aggressively.
Interesting. You don't think that they should tilt at all, or they shouldn't be too
No, I don't think they should be. That most of their equity exposure should be small value stocks, which is, I think, what you're asking about.
Yeah, that's right.
Yeah.
But is it safe to assume that you would support having some tilt towards small cap and value at all ages, and would that shift over time?
If you're able to tolerate the underperformance, yes. And in the same thing that I said about learning what your tolerance is to equity in general early in your career, you should also be learning if your tolerance to small in value underperformance over periods of 10 or 15 years. You should encounter that first and then decide. The young person who's been investing in small and value stocks for the past 5 or 10 years is now in a perfect position to evaluate how they respond to that risk.
Absolutely.
We've been talking quite a bit about things that young investors who are deploying their human capital over time should do, and we've talked about leverage and small cap and value. What do you think about dollar cost averaging, which is just systematically deploying cash, versus the concept of value cost averaging?
Well, let's get one thing out of the way, which is that if you have a lump sum to invest, 80 to 90% of the time, you are better off doing the lump sum as opposed to a periodic approach. Now, the periodic approach has a psychological advantage, and it's certainly suboptimal from a return point of view, but it just stands to reason that lump summing does better than either value averaging or dollar cost averaging, because you've got more dollars in the market over time, more dollar years in the market, if you will. Now, do I think that value averaging is better than dollar cost averaging? Yes, I do, but it's the same sort of phenomenon, which is that with value averaging, you're very likely to have fewer dollar years in the market, okay? But you can get very lucky with value averaging, really lucky with value averaging. If you start value averaging and then 3 or 4 years into the process, you have a real market decline, then you wind up putting a great bulk of your assets in at those very low prices. So it can work out both ways, but the rewards of value averaging, if you're at all fortunate, can be very high, and that's why I favor it over dollar cost averaging.
Interesting, but it hinges a bit on luck.
Oh yes. Everything in investing hinges on luck.
That is a true statement.
And in fact, 90% of your results in investing are going to be due to luck. And the problem that most people have is they confuse luck with skill.
Certainly do. So at what point does it make sense for an investor to start shifting their portfolio away from, say, an equity bias portfolio towards one that holds more fixed income? And is it an age thing? Is it you've met your personal goal thing, or is it really a preference thing in your mind?
Well, it certainly is a risk thing. If the one thing that gets quoted back to me a lot, and I stole from a guy by the name of Richard Ryan, who was a bond analyst and consultant, which is when you've won the game, you stop playing. So if you're someone who has accumulated enough assets to maintain body and soul through the bulk of your retirement, 20, 25 years of worth of residual living expenses, then you really ought to be taking risk off the table. I don't mean sell all your stocks, but certainly cut back on your stock exposure so that if you do happen to have a bad result in the stock market, you will not be eating cat food. And it becomes sort of a Pascal's wager. You can make a mistake, if you will, by selling out and then having the market go higher. You know, you might have been able to buy the Beamer or fly first class, and now you don't have that opportunity. But I can assure you that the mistake in the opposite direction is a much worse mistake to make. If you can't buy the Beamer or fly first class, you will have regret. I can assure you, you'll have a lot more regret if you make the opposite mistake, which is to maintain a high stock allocation into retirement and see your portfolio get cut in half. And then run out of money after 7 or 8 or 10 or 12 years, which can easily happen to you. Now, that's all dependent on your burn rate, all right? For example, it's an irrelevant question to ask to the person who's got enough, at least the American, who's got Social Security or a pension and enough to pay their basic living expenses. It doesn't matter what that person's stock portfolio does. They're still going to always be able to pay their rent and put groceries on the table and not have to move in with their kids. All right. And so it all depends on what your burn rate is. That person has a burn rate of 0 out of their portfolio. Mm-hmm. If your burn rate is only, 1 or 2 or even 3%, you can probably still be fairly aggressively invested in stocks. But if your burn rate is 4 or 5%, then you best seriously consider reducing your asset allocation to stocks as you run out of human capital. That is when you're, 55, 60 years old.
You may have just answered this question with the discussion on burn rates, but earlier we talked about the difference between volatility and risk and stocks potentially being less risky given a long enough period of time. In rational expectations and in your comments just now, you talk about once you reach that liability matching portfolio, you should take risk off the table. How do we reconcile that idea of taking risk off the table once you reach the LMP, the liability matching portfolio? How do we reconcile that with the idea that stocks can be less risky than bonds over a very long period of time?
Because over shorter periods of time, then the stocks are certainly riskier than bonds. What's the sort of crossover point? It's somewhere around 30 years. Maybe it's 20 years. Maybe it's 40 years. I don't know. But the bottom line is, if you are 65 years old, you are squarely in the short-term risk pool. Okay. If, on the other hand, you're 30 years old, you are in the long-term risk pool, and that's the basic reason. Academics like to play this parlor game: is do stocks become riskier over time or less risky over time? And the orthodox answer is they become more risky over time. But it's really a stupid question to ask without adding at what stage of your career. Okay. Clearly, if you're a young person with an excess of human capital and you're saving, bonds are riskier than stocks. All right. But if you're a retired person who is 65 or 70 years old, clearly stocks are riskier than bonds because you're much closer to being in the short-term pool than the long-term pool. And you might say, well, someone who's 65 can easily live to be 95 or 100. And that's true. But the risk doesn't occur at age 95 or 100. The risk occurs when you're 68 years old and your stock portfolio gets cut by 60% and you're burning 5% per year. And so that clearly puts you in the short-term risk pool, even though you might be living 30 or 40 years.
Yeah, that's interesting. The higher your burn rate is, the more short-term liabilities that you have, which makes equities riskier.
Precisely.
Yeah, interesting.
So what do you think about annuities, and when would you ever recommend people to consider them?
Only in the rarest of circumstances. And the person who I would consider for an annuity would be a young person who has no sheltered assets at all, who wants to buy a tax-inefficient asset class that they think has high expected returns. And it's a passive asset class. And so that would be REITs and high yield bonds. If you want to invest in those two things, it's not wise to do that in a taxable portfolio. At least in the United States, it's not. And so the place you want to do that is in a sheltered portfolio. And there's only one company, I try not to mention names of companies, but there's only one company that offers a very low cost annuity that provides index funds or passively managed funds in those two asset classes. That company's name begins with a V. That's a very rare circumstance, though. Most of the time, a variable annuity is not a great idea. Now, a SPIA, a fixed immediate annuity, is not a bad choice for some people who have a high burn rate. But at least in the United States, before you even think about investing in a SPIA, you should right off the bat be delaying your Social Security or your pension payout to the oldest possible age to get that possible high payout. Because what you're doing when you buy a SPIA or you delay Social Security is you're buying longevity insurance. And in the United States at least, there's no better longevity insurance than delaying Social Security to 70. Now, I have no idea, and maybe you can tell me what the Canadian equivalent of doing that is.
It's identical. Different name, Canada Pension Plan, CPP, but same concept. A lot of our audience, and I know you speak this language, a lot of our audience are physicians, scientists, engineers, which maybe speaks to the questions I was asking about why not an all small cap value portfolio. How would you describe the difference between financial systems and, I'm taking this from your book, Rational Expectations, the difference between financial systems and airfoils or electrical circuits?
Well, I have my audience, I suspect, is very much similar to your audience, which is people who are very numerate, who are good with numbers, and they tend to be engineers and scientists. And that's great. One of my mentors in this business of financial writing, a guy named Scott Burns, who trained at MIT as well as learned to write under Archibald MacLeish, told me that the problem with doing financial writing was that for 90% of the population, fractions are a stretch. And if you're not one of those people, if you're someone who's good with numbers, then God bless. But be beware that there's a trap. Because if you're the kind of person who lives and breathes models, you expect those models to be accurate descriptions of the universe. And that is certainly not true with finance. It's like, expecting the laws of physics to work with finance you're going to be very, very disappointed because you're working in a world where the equations will change and where the empirical data will change from year to year. And the mistake that I see engineers making is they think that if they can just get one more year of data, if they can refine their correlations to one more decimal point or their standard deviations to 2 more decimal points, they've achieved the holy grail. No, they haven't. And what I tell all engineers is to forget the math you've learned. That's useful. Devote all of your time to now learning the history and the psychology. And one of the things that any stock analyst, any person who runs an analytic firm will tell you is they really don't want to hire finance majors. They actually want philosophy and English and history majors working for them. They do a much better job of dealing with stock markets than the mathematical types do. Now, that's different with bonds. If you're dealing with bonds, then you want rocket scientists. But if you're dealing with stocks, then you want linguists and philosophers working for you.
All right. Now you basically just answered this question, but I want to hear how you answer what I'm going to ask here. Should people be using mean variance optimization to optimize the allocations of their portfolios?
God, no. The term, my favorite term for mean variance optimizer is an error maximizer. It's useful as a teaching tool. It can answer some very limited questions. For example, if I say to myself, precious metals equity has a very high volatility and it has a zero long-term return, or about a zero long-term return, what is the minimum return I expect it to have that I wanted in my portfolio? And you certainly don't want to even use it to tell you how much to put in your portfolio. You just want to first order estimate of should it be in my portfolio or not. And then you can start to answer that question. But beyond that, if you expect your portfolio to fall out of a black box, then you're going to find yourself sooner or later in a world of hurt.
You use precious metals equity as an example there. The most common thing I think I see from a mean variance optimization example is gold. Well, gold and long-term bonds. But I'm going to ask about gold. What do you think about gold? Not precious metals equity, but just gold as a portfolio allocation.
Well, for starters, I will say this about gold. It's a higher long-term return than precious metals equity has. But the problem with gold is that it really isn't that volatile. It's no more volatile than stocks. And the beautiful thing about precious metals equity is that it's basically a leveraged debt on gold. And so even though it has lower expected returns, I actually prefer it because the volatility of it allows you to do volatility pumping. So several times over the past 60 years, precious metals equity has lost 75% of its value, which, and then that reverses it. The opposite things happens on a geometric basis. Within a year or two, it can triple or quadruple its value. And that's a wonderful kind of asset class behavior if you have a very small percent of it in your portfolio and you are disciplined enough to rebalance the portfolio. Precious few people in this quadrant of the galaxy have that kind of discipline.
So I have a question I can hear lots of listeners asking themselves right now. So Bill, you're a medical doctor and a markets historian. Can you really say that you look at this, the result of this COVID pandemic, and has it caused you any deep concern for your portfolio that, say, is different from past big market events?
No, I'm not at all concerned about my portfolio. As Mark Twain supposedly said, but he probably never did, that, history doesn't repeat, it rhymes. Every time is a little bit different. The crisis that this time it was different than past crises because the precipitating event was different, and future crises will be different as well. What really scares the bejabbers out of me about securities markets these days is that it's increasing the wealth disparity. And in the United States, for example, what you're seeing are people who have lost their jobs, who have very modest savings in a deferred compensation plan in the U.S., a 401k plan, let's say, and they're having to raid that to put groceries on the table. Who are they selling their stocks to? Okay, they're selling the stocks to fat cats. All right, probably like you and I, and so we're getting richer, and in the United States, at least, people at the bottom wrong end of the socioeconomic spectrum are getting hammered, and it really makes me angry, to be honest.
Yeah, I think you wrote a blog post about that on your website recently about the redistribution of wealth.
Yeah,
we can link to that.
Yeah, I mean, who are the people? Who are the people who are cashing out their 401ks? Who are they selling their stocks to? They're selling their stocks to people who've got lots of T-bills sitting on the side who see an attractive bargain. That's what happened 2 months ago.
Well, there's also some data that came out recently from, I believe, Fidelity on the number of investors. I think it was over 30% of investors over age of 60 or 65 went completely to cash in their portfolios.
Yeah, that's one of the ways. That's one of the ways that it happens. But the biggest, by far, people losing their discipline. That's a problem, but it's not as big a problem as people simply losing their jobs during this crisis and having to raid their retirement plans at low prices. To say nothing of the tax cost.
Exactly.
I guess it to an extent speaks to the importance of proper planning, but in a lot of cases, I know that's just not possible.
Yeah, good luck in the United States having an emergency fund if you work at Walmart.
Yeah, exactly. Well, one of the things that I've heard a few times throughout this crisis that we've are living through is that this time it could be different, and this time it could look like Japan. Is there any merit to the comparison between the United States right now and Japan in 1989 or 90?
Anything is possible. The United States once before did see a loss of equity prices that approached 90% from 1929 to 1932. That was due to very extraordinary circumstances, a tone-deaf central banking system that did exactly the wrong thing, And what caused it in Japan was simply that equity prices were so out of line. The peak of our bull market, occurs generally somewhere around a PE of 30, not a PE of, very close to 100, which is what it was in Japan. So it's not surprising that Japanese equities fell by so much. When you start with a PE of 30, you at least have a little bit more of a cushion when you start with PEs of 90. So I think it's possible. I don't think it's likely.
So other than the scientific methodology that you used in both careers, what similarities have you found between being a neurologist and being a financial advisor?
One of my pet peeves are people who call themselves neuroeconomists. These are people who've taken a couple hours of coursework and have dissected a sheep's brain, and they've got their certificate that says that they're neuroeconomists. I actually don't think that standard neurology or medicine does you much good in finance, with a couple of exceptions. Number one is, if you are scientifically trained, which hopefully you are as a medical doctor, then that's a very useful mindset to have in investing. The other thing that's really useful that medicine provides you with is the recognition that early childhood experience is very formative. So when I talk to people about money, I often start with asking them what were their childhood experiences of money. For example, one of the things you learn very quickly is that people who are spenders and don't save, we can be Warren Buffett, and if you're a spender, it doesn't do you any good. And spenders tend to be people who had very authoritarian fathers and who came from very poor backgrounds. That's a very bad sign. People who train in architecture tend to be trouble because they want to be constantly, redesigning and renovating their houses. I've yet to meet a really rich architect, and you learn that in medicine too. You learn that certain traumatic childhood experiences produce certain long-standing medical syndromes as well. So you learn, if medicine teaches you anything, it's the importance of early formative experiences in finance and how people look at money.
Can you talk about, I'm just curious, how and why you transitioned from being a neurologist to this industry? Like, you let go of a practice that you worked for years at and became a financial advisor and an author.
Oh, it got old. I'm easily, one thing that I guess you need to know about me personally is that I'm easily bored with medicine. It's very rewarding. I enjoyed neurology immensely. But after doing it for 15 or 20 years, I was looking for something else that would put me on the steep part of the learning curve.
Fascinating.
But you've been at this one for a while now.
Yeah, I have been. But if you notice, I write less and less about finance. The last serious bit of finance that I wrote about was maybe about 6 or 7 years ago when I came out with my booklet series and I wrote Rational Expectations. I haven't been doing a lot of financial writing at all lately. Most of my writing has to do with historical topics.
Non-financial historical topics?
Yeah, pretty much. I wrote a book on communications technology several years ago. Before that, I wrote one about world trade. I'm just finishing up a book on mass delusional behavior, which does have some bit of finance in it, but it's mostly about psychology and end times manias. Those are the kinds of things that interest me these days.
Fascinating. What do you think? What do you think the impact on global trade is going to be following this crisis that we're going through?
Isn't that a good question? It certainly isn't going to do good things for the length of global supply chains. I think that people have come to realize just how fragile they are, and they're going to get shortened a little bit. But we still are left with a global manufacturing system and consumption system that is very global. And were we to go back to the 1930s, I think we would start to see economic damage that would dwarf what we're seeing now. I think it's a natural ebb and flow. I think the United States has yet to learn the lesson that the world's other developed nations have, which is that if you're going to have a globalized economy, be part of the global economy, you had better have a social welfare system that compensates the losers. You can't be throwing textile workers and steel workers and auto workers to the wolves and take away their retirement plans and their health care and their children's educations when they find themselves at the short end of the globalization stick. You're going to have if you're going to be part of the global economy, you better have a decent safety net. And if you decide not to be part of the global economy, you're going to find yourself with much bigger problems.
You mentioned earlier that part of the 1930s being so rough on stocks was the poor central bank response. What do you think of the central bank response in the U.S. anyway during this pandemic crisis?
It's mostly been pretty good. It's certainly better than the response of 08, 09. What they should have done back in 08, 09 was wipe out the bank management, wipe out the bank shareholders, give the bank bondholders a very big haircut, and save the depositors. All right, and then recapitalize the banks and sell them back to the equity markets at a great profit in 2 or 3 years. And that's not some far left woolly fantasy. I mean, there are a lot of libertarians who believe that's what we should have done, including starting with Gene Fama. Has come out and said that. But we haven't got to that point yet. But if we do have a banking crisis that segues onto this, and I don't rule that out, there are a lot of bad debts out there. The tide hasn't gone completely out. We haven't figured out yet who's been swimming naked. And when we find that out, we hopefully will behave more intelligently and avoid the kind of Tea Party backlash that this country saw back 10 years ago.
Yeah, interesting. All right, I've got one more question for you. Yeah, I'm quoting from Rational Expectations again, because again, that's the book of yours I've most recently read. You talk at the beginning of that book about how since you wrote your first book, you've learned a ton about writing and communicating, and about yourself. What have you learned about communicating financial topics since you wrote your first book?
It's almost impossible to do. The subset of people who have both the mathematical chops as well as the emotional discipline and are willing to learn some financial history, that subset of people is very tiny. And I've sold a lot of books to people who fit that subset. But if that subset was more than 0.5% of the population, I'd be a millionaire by now from my book sales. And I haven't become a millionaire from my book sales, I can tell you that. I found that it's, and you asked me that, I think, off camera, which was, how do you talk to people who don't get it? And the answer is you don't do it. You're banging your head against a wall.
Where does that leave?
Where does that leave
Those people?
Investors? It basically leaves most people in the same situation they would be in as if when they got onto the airplane to fly to Chicago, and instead of turning right and going to your seat, the flight attendant tells you, no, you're turning left and you're flying the airplane. Okay, we don't expect people to fly their own airliners. We don't expect people to take out their kids' appendix, and we sure as heck shouldn't be expecting them to do their own portfolio management, because that's harder than both of those things.
Interesting. So you're saying for a large subset of the population, some form of financial advice makes sense?
No, not at all. What I'm saying is that a decent European-style pension system is what makes the most sense.
Interesting.
I mean, it's funny when you watch. It's really hilarious when you watch, a Swedish crime series, and they open up, the proverbial suitcase, and the proverbial suitcase has 1 million kroner in it. Okay, that's what a Swede thinks is a large amount of money. 100,000 U.S. or Canadian because the Swede doesn't need to save $2 or $3 million to retire. They don't even have to worry about that. Whereas an American has to save a couple $1 million to retire successfully, because there's no social welfare system in back of them, save for Social Security, which doesn't provide very much.
And that was the original impetus for you to dive into this field, right? Because you did not have a pension plan beneath you, so you had to do your own homework for your own future.
Exactly. I realized I was going to have to do it for myself. I live in a country that doesn't have a functioning social welfare system. So I was going to have to figure out how to do it for myself. And lucky for me, I could do it. And then which I didn't understand at the time, I also knew how to write, which I didn't understand until I was about 50 years old. And so that was a very, happy junction of skill sets. Having said that, I can't dance, and I'm no good around, fixing the house. But at least I had two skill sets that amounted to something.
So that's the perfect setup for my last question, which is, how do you define success in your life?
Oh, that's easy. When you get to my age and your kids still want to spend time with you, then you're a success.
Amazing. Bill, this has been a real pleasure. It's been a lifelong ambition to get a chance to meet you, and this has been a real treat. So thank you very much for your time.
My pleasure. You take it easy.
That was great. Thanks.